Hello and welcome everyone today to our royalty panel. We're joined today by Brendan Urick of Electric Royalties, also Cesar Gonzalez of Selfish Royalty and Frederick Bell of Elemental Royalties. Hello, gentlemen. Thanks for joining us today. Could you, before we kind of launch into some of the topics we're going to cover off today, can you give us a sort of 30-second introduction? Maybe start with you, Cesar.
Sure. Thanks for having me, Matt. It's been a while since I've done one of these. So Cesar Gonzalez, the CEO and co-founder of Sailfish Royalty Corp. Sailfish is a precious metals streaming and royalty company with assets in the Americas, Mexico, Nicaragua, and Nevada.
So Frederick Bell, CEO of Elemental Royalties. I think the key point to take away from us is 80% of our portfolio is producing royalties and it's precious metals focused, 95% plus.
I'm Brendan Urick. I'm the CEO of Electric Royalties. We're a royalty company really focused on those metals required for the transition to clean energy. And we've got a portfolio of 19 royalties to date. We've got cash flow and we've got exposure to all of the clean energy metals.
Well, thanks very much, guys, for introducing yourself. I just wanted to have a little session, try and educate some of the newcomers into mining in its broadest context, and help them understand certain aspects of it. Royalties is a new one for most of them. Look, the market's doing some funny things at the moment. And it sort of made me think, in strong markets, like we had in 2020, 2021, investors feel invincible. It's hard to make bad decisions when momentum is with you. But when markets do what they're doing and have been doing for the last 3-4 weeks, there are troughs. It's, shudders to potentially it's shuddering to stop in the face of economic uncertainty. People are getting nervous. Are you? Cesar, why don't I start with you?
I'm a generally nervous guy, so that's a loaded question, Matt. But with regards to Sailfish, not so much. We have no debt. We're cash flowing. We have a dividend that we're paying, which is almost 5%. I'm one of the larger shareholders in the company, along with the other co-founder, Akiba Leisman, and our financial backer, Wexford Capital. So, we're in a pretty good position. We have this also upside in a royalty that is not paying. In fact, it's in the hands of a private equity fund, which has put out very little information on it. And but they have been active sellers thanks to the gold price. They're hitting bids out there, and I'm just waiting for the day that they hit the bid on Spring Valley, this large deposit that we have a 3% NSR on in Nevada, one of the largest undeveloped gold deposits in all of the United States of America. So we've got the cash flow, we're paying a dividend, we've got no debt, very little expenses, and then we're waiting for this event that can really get our valuation higher once Spring Valley is in the hands of an actual company, an operator.
But what I'm interested in, and maybe Fred, you can pick this one up, is the fact that people are just nervous about the economic circumstance of the moment. They're hoarding cash. They're not putting money into junior equities, into explorers and developers. They're not sure how to behave. And this, what I'm trying to get at is, do CEOs of royalty companies have to be agile and adapt, or do they have a longer term strategy in mind which they have to stick to by dint of the business model?
I actually think most people would characterize the royalty sector as having very good defensive qualities in the downturn. And if you look at most royalties, they tend to be royalties on top line revenue. So if your miner is producing $100 worth of gold, they have a 20% margin and get $20. And if that gold price goes down by $20, they're not getting any margin. The royalty company, if you're getting top line revenue, you're getting 1% of that, say, if the gold price goes down by 20%, it doesn't impact you as much. And so I think royalty companies tend to outperform in the downturns. And, at the same time, royalty companies tend to load up in terms of buying into assets, new opportunities, new royalties in those downturns, because they can continue to deploy capital, because they tend to have, good cash flow margins. And I think Pierre Lassonde said, starting a royalty company, you really want to have cash flow there, as one of the founders of Franco-Nevada. And I think, the way we have approached it at Elemental has always been start with the foundation of cash flow, diversified cash flow and revenue. And if you look at us since we started in 2017 as a private company, we've increased our revenue year on year, I think almost a 90% compound growth rate on the revenue side. This year will be another record for us. I think 10 to 12 million US revenue is our guidance. based on $1,800 gold. So from that perspective, yes, always cognizant of the market conditions, sector conditions. But if we are generating cash flow, and if we have instruments that are defensive and tied to commodity prices and can be an inflation hedge, then I think actually a royalty company is a really good way to play the market, even in cyclical downturns.
Okay, and Brandon, I'm going to bring you in here. So Fred said royalties tend to outperform equities in the long run, right? In a downturn, right? But they're not. You guys have all suffered over the last 4 weeks, just as equities have. The market uncertainties are there. So people aren't thinking like that. You know, where are they rushing off to? Are they rushing off to crypto or Bitcoin? Are they hoarding cash? And if they are, what would you say to those people? Do you agree with what Fred's saying? You guys tend to outperform, so you should think of us slightly differently than you currently do.
I think wealthy family offices have been using royalties as a means of storing value for a very long time. At the end of the day, royalties are basically rights to cash flows from very, very rare metal deposits, around the world. And so, those metals are going up. It's definitely an inflationary hedge. For our kind of respect, lithium prices were up 400% last year. And so that means that the revenues we'd expect back on those royalties are up 400%, year over year. So in an inflationary environment, there's definitely, I think, a defensive nature. I like Fred's point though about our operating costs, right? They're basically $0. And so we're going to be the lowest cost producers out there. We're never going to be in trouble for debt or, going under. All those costs are borne by the operators of those assets. Last year we had over $150 million raised. A lot of that's going into the ground, developing our assets, and that costs us nothing. And so, when you add in the fact it costs us nothing to hold these royalties, there's a lot of accretive growth that goes on for a royalty company as they move forward.
It's true. It's what you say is true. I mean, Cesar, if you agree with Brendan, the company needs to bear the cost, but you're out of control though, in that sense. You're waiting for the company to do the right things before we can, capture that revenue, aren't you? So I guess the question I'm saying, you're kind of fully committed when you've made the decision about which royalties you're going to commit to, right? Which companies you're going to commit to, which management teams you're going to commit to, because they've got to get it right before you can benefit from that.
Matt, actually, I wanted to follow up on a point that Fred made, which, when you asked the question, I wasn't really thinking about this the whole way through, but you made a very good point in that the equity market is crap right now for gold mining companies and resource companies. A little different for oil and gas, but in mining, that is actually an environment where royalties become more attractive to them to finance their projects, to advance their companies. And so it should be an environment where royalty companies can get deals done. And you've seen that, especially some of the larger companies with these big financing packages that they put together, where it's very comprehensive, right? They do a royalty, they do mezzanine financing, but they may even take some equity. So it's right now is an opportune time for guys like us to roll up our sleeves and find something to do.
It is, but come back to my question, which is, it isn't the fact you guys have got to be positive about, your story, because you're more fully committed than, say, a fund or institution who comes invest in something. When something goes wrong for them, they can just sell out and may sell at a loss, but they can get out pretty quick. You guys are in it for the long haul. Doesn't that kind of reduce the appeal for royalty companies?
Well, it could be an opportunity to restructure and get something more favorable. I've seen that happen. I've actually been a part of that. I'm sure everyone on this call has, where the operator comes back and says, hey, this isn't working out, but can we do this? And you get more later to get less now, or get exposure to something you didn't have exposure to before. So it creates opportunities.
What do you think, Fred?
I think that, look, one of the, if you're talking about getting exposure to opportunities, one of the great things about a royalty company is more is better. And sometimes you don't say that with miners. Sometimes you say, guys, focus on this one asset, develop it. And we were talking to people here in London today, and one of them was in the mining industry, and they were talking about a recent operator, and it's a new operator. And they said, look, as investors, our preference is for that operator to actually not go into any other mines, because those mines might have a 10-year horizon, and it might take them 10 years of exploration, and then it might not work. And so they said, we almost prefer that they don't do that. Whereas for a royalty company, people actually want increased exposure, optionality, and diversification for some of the reasons that Brendan touched on, are that you're not contributing capex to them. You're not contributing ongoing costs. And so if you can go out there and you can identify good opportunities, and particularly in a rising commodity price environment, projects that maybe have been sitting around for 2 or 3 years and that are being advanced and are becoming, economics are improving, that's actually a really good place to be as a royalty company. And it's one of the key benefits. It's one of the reasons I set up Elemental is because I had worked in a junior company and I had seen how difficult it was, and particularly in bad environments and what the market was. And I thought, hey, actually sometimes I'd like all my eggs not to be in one basket. And I would quite like to have optionality and exposure to 2, 3, 4, 5, and we're at 10 assets now, majority of them producing. And that's a great way. And I think that's what people come.
Brett, I think we got into the royalty game the same way. After seeing how risky it is. Mining is a risky game. There's a lot of things that can go wrong. It is an average 15-year development timeline. So diversification, that's got to be one of the big benefits. Like Fred said, they've got more than a dozen royalties. We've got 19 royalties. I'm sure Caesar's got a pretty good portfolio, but that means that none of our assets are worth is really based on one asset, and one asset can always go wrong. It doesn't really matter. You could have the perfect team. It could be the perfect place. You just never know for sure. So diversification being a really big one.
I was sort of intrigued. We've interviewed a couple of CEOs recently who basically changed their economic studies to get them into production sooner because they're nervous about inflationary effects in the marketplace and the ability to raise capital, when they need to. So I think it's sort of interesting that some of the companies are thinking about, well, how do we get into revenue sooner? I mean, are you seeing that, Caesar? I mean, you guys look in the market all the time at deals. So are those the sorts of conversations that you're aware of?
Oh, yeah. In fact, Bonterra, where I'm the chairman, is doing just that. We are doing a PEA on an open pit that has measured ounces, which can be converted to reserves to get something going. We have a mill that's operational. There's an expansion plan, but we brought in a new CEO who was the COO of a very successful intermediate company and put 2 mines into production there. So we want to get ahead of this as fast as possible, just get it going, start small, bootstrap. So yes, absolutely.
Okay. Well, Fred, any thoughts on that? Are you seeing the same sorts of conversations?
Yeah, I think it was actually some really interesting market commentary in the last week from some of the analysts in the industry. And they were saying that they're actually starting to recommend clients to move into the royalty space. And the reason for that is cost escalation. And there have been some pretty big sort of name projects that had $1 billion capex a year ago. They're now 12 months in. And they're saying, okay, we've got 20, 30% creep here. Now, if you're an equity holder there, that's $200, $300 million more that you need to come up with. It impacts your economics. If you're a royalty holder there, maybe that's a delay. Maybe it takes them an extra 2 months financing, but there's no cost contribution. So actually in an inflationary environment where you are on the top line as a gross or net smelter royalty holder, that is a really good place to be in. Go back to the last cycle, go back to 2003 to 2007. And, a lot of commodities increased in price. And people didn't see a corresponding increase in returns by some of the miners. And I was I worked a bit in Australia when I was younger. And I remember seeing the wages in Australia. And it got to the point where someone I knew who was a geologist in Sydney, fresh out of university, was being flown every 2 weeks, business class to Perth to work. And then the company was flying for her to go back every 2 weeks. And the week in between, they were flying her boyfriend to Perth to see her. And the costs, it was the best job she probably got in the last 8 years because you just had to pay people more and more. So what happened is inflation in costs eroded all the increase in commodity prices so that investors didn't see the same returns that they would have expected. And that's where a royalty company is great. And that's where you go back over time and go back through history and you look at some of the old royalties written at $300 gold. And, those companies did economic studies and ignored the deposit at 1 gram because everyone said it's irrelevant and it will never come in. And 20 years later, it's a much bigger mine. It's mining that, and they've never had to put another dollar in. So I think multiple reasons there, but I think royalty is actually almost at its best in the kind of environment you're in today, where commodity prices are rising, but inflation is eating away a lot of that gain.
I mean, yeah, interesting times, and I think there's I guess another whole conversation around the costs are not just rising inflationary, to everyday homes, but for mining operations, the cost of staff and equipment and delays, and therefore the cost of capital. It's all adding up. But does that mean? So it comes back a little bit to an earlier question I asked about where. Do you think of the structure of your portfolio differently as a result of this current environment? In terms of, Fred, you've mentioned you wanted to lean towards the revenue generating assets quickly, but in terms of that balance between revenue development and exploration in the portfolio, and I'm hoping that there's something that normal investors can get out of this. So how has your thinking changed, Brendan?
Yeah, well, cash flow is always important. The nice thing is a royalty company, our G&A is very low. So we don't need a lot of cash flow to be cash positive. I like to take a portfolio approach personally. When you're buying in and an asset's already producing cash flow, you're paying 7-8 years cash flow. You're basically paying the net present value you'd expect to get back for that royalty. It's just, where pricing is. Whereas if you buy an earlier stage, and really the most value accretive would be kind of right before economics come out and everybody knows how much money they're going to make. But when you're going to get into that stage, you actually capture all that value, where somebody else is going and putting in $80 million, and advancing that asset forward. And as closer as it gets towards production, that's all value that, you gain by doing it a little bit earlier stage. So we kind of take a little bit of a portfolio approach. We want to get, increase our cash flow. Our target is to get really 5 to 6 producing royalties, so we can go get some debt and, we don't have to dilute anymore. But at the same time, the deals that are really going to build the company, create all that value, where we can see ourselves getting to, 25 million in cash flow, kind of 5-6 years out. That's where, we're getting it a little bit earlier stage and trying to capture some of that value through development.
Do you think the market's getting it slightly wrong in terms of the valuations of the different royalties companies seem to be very little commonality in terms of the rationale? It seems to me there's companies that lower valuations, which have got better assets and revenue than others, and I kind of struggle to work out what I need to be focused on. So do you think the market sometimes just gets it wrong? And if it does, what sort of problems does that cause you? Caesar, if you want to pick up on that.
Yeah, I'll quote the famous Warren Buffett. He said, in the short term, the market is a voting machine. In the long term, it's a weighing machine. And I have a lot more respect for that, coupled with what I know now about liquidity. So when you have these times in the market where liquidity is a premium, and you have small companies like ours, the three panelists here, you take a hit, even though you're adding value in the business by buying another royalty that generates cash flow, buying one that is a little further away but has great prospects. The lack of liquidity gets a discount, even though you're making the business better. In the long term, that should iron out, and I think it behooves us as smaller cap royalty companies to figure out a way to improve our liquidity. Exactly. Some M&A, some mergers to create scale, to give investors what they really deserve, which is the ability to buy and sell stock at will, and to not worry that one day when they want to go sell, the door's going to be shut, and therefore they buy less than they would normally want to buy because of the lack of liquidity.
And the royalty sector is, one of the most active, I would say, in M&A. I mean, there was 7 guys that existed on their own for, a 10-year period because they already ate everybody up 10 years ago. And now you've seen this, flurry of new companies coming into the space. I think it's only a matter of time before M&A really, starts to take off at some point here.
I almost feel like that's a good segue. Maybe I should have started with it on Elemental, but for viewers, we actually had a unsolicited hostile bid that was formally launched in January on Elemental, and it's sort of reaching the conclusion of that bid timeline at the moment as we're filming this, and I think our view has always been, and we've said this publicly, our view has been consolidation makes sense, but also the markets, as Cesar said, are at times inefficient, and particularly in smaller, less liquid stocks. And so, when Cesar used that famous Warren Buffett quote and said it's sometimes a weighing machine, in the royalty space, sometimes it almost feels like the more royalties you have on the scales, the greater mass you have. And that absolutely isn't true. Sometimes you get a tier one royalty on a tier one asset that can be worth more than 500 royalties, spread out on 500 assets. And it really comes down to the asset itself and the quality. And one of the advantages of the royalty model is you've got this diversification we've talked about, and you've got all this optionality and all these different projects. One of the challenges is investors misprice single asset companies all the time. And if you're in the mining sector, you see it. So, how much harder is it to accurately price a company that has 30 royalties or 40 royalties, and they're spread across different operators, different jurisdictions, different development stages? I mean, it's hard for us as royalty companies sometimes to keep up with where peers are and, what's happening on their various projects. So if you're a private investor and you're coming home on a Wednesday night and reading a quick presentation on a company, I mean, you have to be pretty sharp to get a really good idea of value. And I think that's where, I think M&A will happen, but I think it will be selective. And I think the three key criteria that we see in terms of value in a company are quality. Fundamentally, I don't want a royalty on your back garden because, maybe there's some gold there. I want a royalty on an asset that we actually believe one day might come into production and pay us revenue. The second one is that point, revenue. Good quality assets and revenue. I think that's always prized. If you have cash flow, it gives you, especially with low cost companies that Brendan talked about, gives you a lot of flexibility. It gives you capital to deploy. And then the third one, and this is where Cesar was talking, I think, and this segued into this, was scale. Scale definitely helps. And with scale, you typically have margin expansion, because if you go from 2 royalties to 4 royalties, you don't necessarily go from 4 employees to 8. And so you get the benefits of scale as you go. And so I think when you look at M&A, I would say look at the companies that have at least 1 or 2 of those attributes. You don't have to have scale. And maybe there's an argument that all 3 of us on this panel today, we don't have the scale of some of the mid-tiers or the majors, but we tick some of the boxes in terms of quality or revenue that could be attractive, accretive, and could make sense for other companies to merge with.
For the right bidder at the right price. And we news in? No. We will know after this phone call, the outcome. Perhaps you'll come back on and tell us all about it, the ins and outs of what you've been through or going through. But I understand M&A is important. But some of the other interesting things you said there, Fred and Cesar as well, was that you need to be better at judging where you place your capital, because it's got to hit a certain set of criteria. Otherwise, you just get this kind of amorphous mass of investment, which may be valued all the same, whether it be positive or negatively. They're all valued the same because no one can be bothered doing the work. Not the institutions, certainly not retail, because they don't necessarily have the skill set. So I've got to ask, I need to rely on the management team's credibility here. So why are you guys any better at working out what good looks like than the funds or the institutions who perhaps do ETFs, which could be argued as a similar product, right? How do you answer that?
Well, mine might be a little bit easier of an answer than Cesar and Fred. Just because we're really the only group out there focused on a lot of the metals that we chase. We're targeting 9 clean energy metals. There's really only one private equity group out there that's focused on this space in the mining, Pallinghurst. And so there's we're picking up assets that are just like our tin deal that we just announced. That's the best tin asset really in North America. And so we picked that up. We didn't have any real competition. It was pretty cheap. It was about $100,000 cash, 1 million shares of Electric Royalties. So for us, it's a little bit different. You know, we're going out there. We've got royalties on the only manganese district in North America being developed for the EV space. There's really only 4 of those developers globally. So it's a little bit of, I think, a different beast for the clean energy metal space. But it's fun. I'll tell you that as a first mover right now. So we have a little bit of a benefit, I think, in terms of competition.
And what do you say? I mean, it's a little bit different for you, Cesar, because you've come from an institutional background. You've got the Waterton sort of running through your veins. So, how would you defend that position? Why shouldn't I, as an investor, just go and if royalties are too complicated to understand, why don't I just go and get an ETF or some vanilla type project where someone else is doing the heavy lifting? Why are you a better bet?
I like Brandon's response. I wish I could say the same, but the precious metals royalty sector is very competitive, and we have an advantage in that Sailfish came from an operating company. It was spun out, kind of like Franco-Nevada was spun out of what used to be Newmont. You know, and we have access to a team of operators who have a lot of experience in the Americas. You know, I'm bilingual. I speak English and Spanish, and have been part of 2 mine builds in Mexico and in Nicaragua, both open pits, one a heap leach, one a mill. I'm also the chairman of Fonterra, which is starting off with an open pit in the Abitibi, but we're going to transition to underground, not just on the deposit where we have the open pit, but at a separate deposit. So we'll have 2 underground mines going at the same time with a mill. So I think you have to look at the bio of the team. You know, Fred mentioned he was down in Australia working on an operating company. I think what you have in the royalty sector are guys that spent time on the operating side. They kind of woke up one day and said, you know, this is too hard. Let me see what's over here with these guys who just we send money to every month or quarter. And, you know, we know what good mines look like. We know what bad mines look like. And you know, it's just also partnering with the right operators. You know, that is very clear. Who has a good track record? Who has, you know, the bona fides of being an operator and getting in bed with them.
I mean, I'm sort of interested in something you said there, Cesar, because it feels like the new kids on the block of royalties in terms of funding, you know, juniors and explorers and developers. I sort of remember back in 2013, 14, 15, a lot of the kind of brokerages kind of moved out of town. The junior mining was hard to get funded. You guys, you know, became de rigueur. You became an option for some of these companies. But as royalties have been around a little bit longer, as it's getting more competitive, do you think, Fred, that the types of deals, the deal structures, the bells and whistles that you are constructing around the headline of royalty companies or streaming companies will change or have to evolve to be more competitive? And if so, you know, what could that look like?
And when you say, you mean the structure of the types of transactions, royalties or streams?
Yeah, like I mean, rather crudely, when I was in banking, I say these companies like money's money. You can call it what you label it however you want. It's the cost of that money that you care about, right? They just wanted money because they couldn't find it anywhere, and we were offering them capital but conditional. Lots of conditions attached, right?
Yes.
And that document got thicker and thicker. You know, by the end, it was like sort of these 400 page documents. So, what is anything going to change in your sector? Does it need to change?
I mean, look, for us, I suppose a recent example is all the assets we have bought to date have been royalties, and they've been fairly, dare I say it, vanilla royalties, straightforward, a 1% royalty, a 2% royalty. You know, the last transaction we did on Rambler's main copper gold mine in Newfoundland in Canada, that we did in fairly recently, that was the first stream we wrote. And one of the benefits of that was we had a lot of flexibility in how we structured it to suit them. And this actually, I think, comes to your point perfectly, because the reason the stream and the opportunity came about for us was they were refinancing and they were getting in a new lender, and that lender needed first ranking security. And so we structured something that enabled the lender to take that first ranking security, enabled them to take on that project financing that they needed on the operating asset. And we came in a secondary secured position. And we structured the stream so that it had a step down as it pays us. It had secondary security to tick the box for their creditor. And it also had minimum deliveries in the first 3 years to protect us on the downside risk. And so we get future optionality to the whole mine, but it steps down, and the better they produce and the more they produce, the faster it steps down. And it enabled them crucially to get that credit facility in place and running in the way they did. So I think for all of those reasons, it was a transaction that made a lot of sense for us and made a lot of sense for them. And I think that flexibility and that ability to construct something that suits both the royalty and streamer or the operator, you've already seen that come on an awful lot. And it will be interesting to see if that continues to evolve. But I think there's a lot of flexibility built in that you can do that.
Yeah, I mean, so it harks back to the days of structured finance in terms of you can write anything on a piece, any kind of agreement on a piece of paper. And I just wondered for you guys to be more competitive and therefore, not just protect your downside risk, but win transactions was good for you, good for your shareholders in a highly competitive environment. Do you expect to see more of this sort of more structured and nuanced?
I think people usually win on price. To be honest with you, I don't think it necessarily comes down to the fine details of the structure. I think ultimately one guy's willing to bid more if there's that kind of competition. Streaming versus royalties, I think that's a whole nother kind of discussion. There's definitely some benefits of the streaming where you do have a security. You're basically obligating them a certain timing of those payments they're going to make you. Whereas royalties, really a bit more friendly for the operator. But I get why groups do it. It also lets you lock in that revenue and forecast guidance. I'm sure that's appealing to Fred as well. But I think you always have to adapt. I think every deal is different. Every situation is different. The needs of the company. When you're getting in and jumping in to help them out, I think it all kind of is relevant on a per deal basis.
So what else have you got in your armory in terms of making it attractive to shareholders, Cesar? I mean, you've been issuing dividends recently.
Yeah, that was round 2 of our capital return program to shareholders. Round 1 was the NCIBs, these share buybacks. We're on our 3rd one. We've bought back over 8.5 million shares of our own stock. We're doing everything we can. I think that some investors would say, instead of doing that, could you have bought something and grown your business that way? If the right deal came along. We recently were part of 2 processes. One didn't start off as a process. The other one did from the very beginning. And we just can't get there on the price that our competitors are willing to pay. So, but we're out there, we're looking, and we're trying to grow the portfolio in a prudent way.
Well, do you know who'd say that? The guy you quoted earlier, Mr. Buffett. That's who.
Yeah, it's all about timing, and there'll be a time when, if we're still around, we'll do another deal. But for the time being, it's very competitive.
It's very competitive, and it must be very tempting to just go out and do a deal just to look busy, right, Fred?
Yeah, I think one thing that actually Brendan touched on, and just in his answer before, and Cesar had earlier on around consolidation, is cost of capital. And the big royalty and streaming companies have an incredibly low cost of capital. So you look at the credit facilities for some of them, it's 1% plus LIBOR, which in recent times has been 1.25%. And you can have a $500 million, $1 billion credit facility at less than 1.5%. I mean, that's less than Barrick, less than Newmont, less than Rio, less than BHP. It's less than almost any other company you can think of. So that almost feeds into the argument that Cesar was talking about earlier in terms of scale. Because if you are a lender and you're a bank, you're looking at it and you're saying, right, the royalty model's pretty low risk, but how low risk? And if you want to be 1% low risk, we want to know that this is covered not 5 times over, 10 times over. We want to know that this credit facility is covered 40 times over with 40 different assets in lots of different countries and different operators. And that is what scale can help you with. And so I think lowering that cost of capital, if you take Brendan's view that ultimately price wins out and dollars talk, then you get into this position where you can be competing with bigger companies with a lower cost of capital. And so it almost doesn't make sense to do that. for the majority of the time because you won't win. And so again, it can come back to this conversation around size, scale, cost of capital, and it's a sort of virtuous circle. The bigger you are, you might have a lower cost of capital, and the lower cost of capital, the better able you are to, accretively transact on opportunities. And so that's why that has been historically M&A in the royalty space. It's why historically that has been, I think, generally speaking, it has been positive. I think that's the sort of, in answer to your question.
I think you have to kind of go where they aren't, because you're never going to beat them on a cost of capital basis. But on the flip side, as they grow bigger, they have to go after certain deal sizes, because a $5 million deal, $2.5 million deal is not going to be accretive to them. It's not worth their time. So I think you just got to find, go to those places where, they're not going to be going, is typically my, my way of going about that. We've also shied away from the commodities they target as well, but staying away from competing with those guys, I think is key. Processes, we haven't participated in one of those in 6-9 months now. I would say we spent a lot of time on that in the first kind of year that we got out of the gate, and we saw portfolios go that triple our value that I would not take over our portfolio. It's just crazy out there. Once those guys get their hands on it.
But do you think the world's changed slightly? Because obviously the Russia-Ukraine situation has changed things dramatically. Iran being a beneficiary of Russian sanctions because the world needs oil, and apparently we're not going to be buying Russian oil or gas. So are there parts of the world that perhaps any of you were looking at, wouldn't look at before, that you now would consider because the whole circulation of commodities and supply chains has changed?
Probably not. We were already risk averse in terms of jurisdiction. Our business plan is to really find those deposits in North America, Australia, and Europe. That could be a domestic source of supply for those metals. I mean, there are countries, a couple in Africa and here and there that we go. But I think if anything, everything that's going on in the world has just kind of more affirmed that view, rather than it driven us away from that.
I mean, Cesar, you've had to deal with this. Where obviously, you've got an asset in Nicaragua, obviously now significantly advanced. But the early days, that was tough. People cared about jurisdictional risk for royalty companies. So, what's your take on the new world order as we see it?
They care more now. However, the asset that we have in Nicaragua is more advanced. It's cash flowing. It's putting out quarterly production numbers, so that mitigates it a bit. But when you go into a country like that and you're trying to build something, the risk of building plus the geopolitical risk are too much for most investors. So I think if somebody wanted to diversify into second and third tier jurisdictions, they should do so only if they're in production or near production, because the penalty for taking something that's that far out of the money in one of those jurisdictions is quite severe.
I mean, and Fred, you're generally West Africa, Chile, Mexico as well. So, but you've seen the same in Chile recently with political nervousness around political status. So, what's your take on it all?
So, I think broadly speaking, we're probably 60-70% tier one in Australia and Canada, but we also have assets in Mexico, Chile, Burkina Faso, and Kenya. So we have quite a wide reach, and I think we've always been guided by the balance of sometimes in the less mature jurisdictions there is greater exploration optionality and upside. You're not looking at a brownfields deposit and mining a kilometer underground. You're in the open pit. You're in the first 10 years of its mine, and in 10 years' time they might be in the underground. But you're balancing that versus the fact that it might not have the same jurisdiction. I suppose people tend to categorize countries at a high level into tier one, tier two, and tier three. And there's a lot of nuance into not even the region, but the country and the province or the territory within that country. So it is a very, you can get granular.
I think it's a really important point you make, because I was literally going to ask you, everyone just broadly says, tier one, we're tier one country, right? Canada, each province has its own peculiarities in the sense that some provinces are slightly more difficult to get licenses and permits in than others. South America, likewise. California is a great one. Some counties are easier than others, but people go, California, not good for mining. That's not necessarily true. But,
wow.
Right?
It's pretty tough. I wouldn't want to be trying to get permits down there. But no, you do have to, within North America, especially, and within Europe. I mean, each country in Europe is obviously different, but provinces are widely different as well. We like Quebec quite a bit. They're very favorable to mining over there. Then you get into BC, and it's there's a big load of projects that have been trying to get permitted for a long time and face some pretty steep hurdles. Obviously, First Nations and some of those issues as well. So yeah, you have to look within Canada and the US. I mean, not every province is equal. Places like Nevada definitely have a clear edge over some other states down there. So yeah, it's different. It's not so easy. You can't blanket code it. As much. And you have to remember too, mining is very much infrastructure related as well, right? So, even within a province, the different regions in that province are going to make a big impact, in terms of the viability of a project moving forward.
Okay, and I'm going to finish with this one, guys. Right? Okay, and this is around what we, the investors, need to be thinking about. So I kind of appreciated today's conversation. It's helped me think about royalty slightly differently, but in the current economic climate, people seem to be hoarding cash. They've been hammered in tech. They've come and had a look at mining, not quite sure where to place their bets. So they're just sitting on cash for now, it seems. Even the draw and the lure of crypto and Bitcoin aren't enough to make them move. So given this environment of hoarding cash, if you're lucky enough to have cash, or less disposable income because we're worried about energy costs, food costs, and all the things that governments are doing to sort of, tax us on, why are royalties a better investment into the mining space than any other product, whether it be equities or ETFs or otherwise? Cesar, I'll start with you.
Yeah, I'll regurgitate some of the qualities of sailfish.
Summarize.
Yeah, summarize, better word. So, some of the qualities of sailfish to make it a good investment vehicle, which are also in other royalty companies. Maybe not all of them together, but some have this, others have that. But no debt. There are a few royalty companies that do have debt. Most of them are relatively under leveraged. We pay out a dividend, a very healthy one, and that's the trend. You're seeing more royalty companies doing that. So that provides some added benefit to a portfolio. Very low operating costs, especially at Sailfish. From day one, we created it as a company that was going to be very shareholder friendly, which means, myself and the co-founder, Akiva, we got paid in shares. It's a form of compensation, but it doesn't drag on the cash flows. It allows us to buy back shares, to pay a dividend. So those two things, return of capital to shareholders. And I've seen other royalty companies recently put in place NCIBs. And I think, but the big one is, we're not exposed to the inflationary pressures that the operating companies are. And also the volatility in the markets presents opportunities for us. We are an alternative to equity and debt financing. So if the equity and debt markets clamp up, we can, get some deals done. So that's how I would summarize it.
Fred, can you build on that?
So look, for me, if you're talking specifically about this environment, and I think a lot of what Cesar said holds true and the benefits of some of the benefits of the royalty model in companies, but I think specifically this environment, I'm worried about inflation. And I think that if I am investing in gold, partly as an inflation hedge, then actually the best way to do that is to invest in a royalty company that has exposure to gold, because you're getting that double protection. You're getting, the exposure to gold, and you're getting the protection from the inflation and costs that all the other gold miners are going to have. So I think that's a really core point. I think in terms of Elemental specifically as a royalty company, if I was going to say, this is going to be another record year for us in terms of revenue, that means increasing margins, increasing cash flows. I don't think it's any accident that we attracted a hostile takeover offer. I think that speaks to the fact that our portfolio has really unique characteristics that make it attractive. I think we're a team that set this up from the beginning. I put $20,000 in to start this company, and with Richard Evans and one of my partners, and we've built it all the way up from, I think, $400,000 revenue to 10 to 12 million forecast for this year. So, we have really built it from the ground up, but we have always had that laser sharp focus on diversified revenue base from the outset, protect the downside. And if we can protect the downside, we all know there is plenty of upside and optionality in the mining industry. But if you can get that blend of downside protection with the upside, then you're in a really good place. And I think a precious metals royalty company is a good way to do that, even more so today.
Okay, Brandon, I'm going to let you have the last word. Take us out with a song.
Yeah, sure. No, look, I think we're all risk averse, all of us up here from the sounds of it. We all decided to get into royalties because we are defensive. We do want to reduce our downside. I think ultimately, in an inflationary environment, there couldn't be a better play than a royalty company that's in the metal space. Whether it's clean energy metals or precious metals, these are, very rare deposits on Earth. We can't print more of it. And so when the rest of the world keeps printing money, those deposits are going to be worth more and your money is going to be worth less. So, just taking cash home and seeing the purchasing power erode, 7 to 10% over the next year, I don't think makes much sense. When you can look at investing in, say, a royalty company like ours, lithium prices are up 400%. We're about half our portfolio is lithium. We're expecting 4 times the revenue from lithium now over the course of 1 year than we did last year. And so, I think there's definitely a much more accretive growth profile there, which is also very defensive. To Fred's point, reduced risk. We're all about limiting the downside risk. And so definitely in a defensive environment like this, where you want to store your money and make sure it's safe, royalty company would be a classic way to go.
Okay, so I'm getting at this. Don't think of royalty companies like a mining equity play. You guys have got a whole bunch of different attributes. Got it. Guys, appreciate your time today. That's been really useful for me and hopefully everyone watching this as well. If there's any questions come through, we'll send them over to you and maybe you can get back to me. Thanks very much.
Thank you, Matt.
Pleasure.